But let's get into some of the talk that we've scheduled for today. It's interest rate trading, a beginner's guide. We are going to dive into the shortest term interest rates you could possibly trade out there. Why? Because that's what's been moving, friends. The Fed is talking about hiking, how many times they're going to hike, how much inflation is out there, how much they're looking at non-farm payrolls and everything else. And thus, I want to dive into the world, Katie, of Eurodollars, look at some short-term rates right now, look at where they're projected to be in the future, and then also look at the shortest term treasury note interest rate, which is the 2-year, compare the two and try to arrive at, for the viewer, hopefully a plan of attack if you have a bias on interest rates moving higher or lower. And with that, I'd love to kick it off with something that I know you've talked about in the past with our mutual friend Pete Molamat, and maybe we've even talked to on the show, which is the Eurodollar futures. You remember your old friends, the Eurodollars?
Yeah, I was going to say, I was really excited to kind of see that you were covering this today, because I frankly just haven't spent, despite the fact that interest rates are all over the headlines, I haven't really drilled into the nitty gritty of how some of the small exchange products compare to these Eurodollars. But when I was first learning how to trade Eurodollars, I was really excited because it felt like the first outright futures contract that I could trade, where I was like, okay, I'm making an assumption on this asset class that is kind of intimidating, but also I'm doing it in a way that's small enough that I can withstand holding these positions for multiple weeks at a time. So it's going to be really great to kind of see how we break down the relationship between these two, and then compare and contrast what might be better for you based on what we've seen the last couple of days, and what we might anticipate seeing as we go into this FOMC announcement today, as well as the one in March, which keeps getting talked about.
Absolutely. A couple of great points there. First of all, everybody is talking about, FOMC, what the Fed is going to do, hikes and cuts and inflation, everything else. And so why are we talking about this Eurodollar thing? It's like Eurodollars in one word. What are we, where does this even come from? Don't worry about investigating what Eurodollars technically are. Just understand that they are one of the best benchmarks for short-term interest rates. Why are we talking about benchmarks for short-term interest rates? Because that's what the Fed directly influences at FOMC meetings and everything else. When they hike or cut, it is directly short-term rates that they are touching. And then you see, an indirect relationship in, 2 years, 5 years, 10 years, 30 years, longer term interest rate products. Now, the Eurodollar, like Katie speaks to, is really, until the small exchange came in here, really one of the most beautiful interest rate products out there because it's direct. We'll get into the math in a second here, but when interest rates move, when short-term interest rates move, the Eurodollar moves tick for tick with those interest rates. There's no math, there's no dollar value of a basis point that you have to worry about. It's very direct. And like Katie pointed out, it's relatively small compared to traditional futures in the space, like your ZN futures, your ZB futures, your S&P futures, and all of those. The Eurodollar, most of them are going to demand a buying power of a couple $100 to maybe $1,000 or so. So it's less risky than those E-mini S&Ps or the WTI crude oil futures. But also I want to hit on this directness factor because, Katie, you can see up until the last couple of months, we were pegged at 99.9, which translates to pretty much 0% rates.
Right.
Do you want to talk a little bit about the math behind this product?
I can try in my explain like I'm five style way, but essentially, isn't it that if you were to go from 100 exactly to 99.75, that would equate to 25 basis points in the short-term interest rate?
That's exactly right. So
okay.
Every tick lower, you nailed it. Every tick lower from say we're at 100 and we go to 99.99, that is going to translate to 0.01%.
Right.
And so it's when you compare it to treasury note and bond futures, like I say, ZT, ZF, ZN, and ZB, it's a lot simpler. It's a lot more direct because you're looking at the ZN and you're like 130. What does that mean? And it's like, oh, well, you have to do a bunch of math to kind of imply what the interest rate is. Here, it's like you said, Katie, I'll even make it a touch simpler there. You go from 100 down to 99, even 99.00. That's 1% in the interest rate. And what that movement portends is essentially the projection of where people think that interest rate will be for that expiration. So this, for instance, is the active month euro dollar, which is to say it's the euro dollar that's going to expire the next expiration, which is March of 2020 here. And so that move from essentially, let's call it 100 down to where it sits right now at, let's just round it off to 99 and a quarter. That's about 75 basis points, or, what the Fed has traditionally hiked in 25 basis point increments. So essentially thinking in the next couple months here that they could have 3 hikes or 1 hike of 75 basis points. That's what that movement means there. That's what they're projecting for the next couple of months here, because this is the March 22 euro dollar. But I bounce this out, Katie. I show you the whole forward curve, and you can see the different projections, not only for March, that's this first dot right here, but April and May and June and on into 2023, March, June, Sep, and December, on until 2024. You can see where these dots line up, coinciding with this dot right here, for instance, is July of 2022. So let's just say summer of this year, they're expecting short-term interest rates to be at 1.5%. I know this is a lot, but hopefully people can let this sink in. And am I making some sense here that euro dollars, the different expirations as you go out in time, are projecting where short-term rates will be at that time?
Exactly. Yeah. And I mean, I think you're making sense. And also, I just love the way that you put together visuals, just as a compliment to you, because having that math equation there when you are talking about something like rates where it is the inverse helps a lot of people out there understand what exactly it is that they're looking at.
Absolutely right. And so you can get into the nitty gritty of it. We'll talk, later. I think we're just really kicking off a nice conversation here on rates and how you can trade them. But you see this hump right here where it goes from, rates, the price of euro dollars being lower and lower, and thus rates being higher and higher. And it actually, there's a hump here, and the prices start to ascend, which means interest rates descending, and that's a slight inversion. We'll speak to that later, but I want to close out with something that's relatively simple here, which is almost direct comparison between the December 2023 euro dollars right now, Katie. That's about 2 years in the future. They're projecting a short-term rate of about 2.25%. Now, the 2-year Treasury yield, which is very similar to euro dollars, there's some difference between the Treasury being risk-free rates and euro dollars having some counterparty risk, so being usually a touch higher in percentage. But, being almost 75 basis points higher than the 2-year Treasury yield, which lines up pretty well with the duration of that December 2023 euro dollar, that's a big fat difference that I think will be interesting. And so if you want to essentially get short-term interest rates or long short-term interest rates, you can very easily just you can sell that 2-year Treasury yield with the S2I futures, or buy it very direct, even more direct than the euro dollars, or you have to commit the opposite action when it comes to the euro dollars. But I also want to open this up to some spread trading and everything else further down the line. But I think this is a good beginner's guide, a good start, right?
Yeah, I think so. And I think maybe just to, again, go back to the explain like I'm 5 analogy, you're looking at December 2023 because it's the closest duration right now that we have to compare to that /S2Y. So I guess my only follow-up question to you, and I know we're about to go over here, is, we were just looking at H 2022. Is there a reason to not look at H of 2024, or are we kind of splitting hairs at that point?
splitting hairs a little bit. So yeah, I'm glad that you asked that. Yeah, I like to usually kind of defer to the DECE contracts just because it's clean. It's like, okay, by the end of 2023, we're expected to be at 97.75, which is 2.25% there. So yeah, you can look at the March of 2024 if you'd like there. But yeah, we are running out of time, Katie. Thanks as always. And everybody out there, make sure to check out our community.